Schedule. Let's do it live. Let's do it live.
There we go.
Live.
We figured out technology. We figured out the technology.
Hey, it only took 10 minutes. Thanks for joining us, everybody. This is your old buddy Josh and your old buddy Amar from San Diego. It's going to be an interesting topic today, especially when I looked today. I saw the Nasdaq's down another 500 points, Amar. The S&P 500 is down. I don't even know how much it is, but we're getting some tough times, and who knows how long it's going to keep on. I don't know. But a lot of people, Amar, have been asking me about buffered ETFs, and frankly, I haven't done a whole lot of research on them. I'm familiar with structured notes. We talked about that 6 months or something like that. But we got some good stuff. Amar has with buffered ETF. So let's go into your disclosure first and foremost, Amar.
Yeah, we'll put the disclosure up here. That way we can get that out of the way. But while we get the disclosure up, we were having some technical issues, so I just want to make sure that people can hear us. And we had 2 links out there. So if you're on the other link, come join this link because that one's dead. Well, I guess they can't even hear us if we say that. You
got the little thing that says how many people are on or anything like that?
I see 5 people are on, but here's the disclosures. We're not taking your specific situation into account. We haven't. This is not advice. This is just educational purposes only. And if you want specific recommendations, you have to enter a client relationship in order for that to be true. So, Josh, I got this email from, this was sent to us as a firm. So I'm going to share this email here. Is that coming through? Can you see it? On my screen, it looks really small. But
it's very, very small. Yeah, I would make it bigger.
Here, I'm just making it. Trying to zoom in.
This is funny. Absolutely.
So it says de-risk portfolios from market and election-related risk. Unlock strategies for 100% downside protection and upside growth potential in today's market. Calamos, it's a fund company. They got the SVP, Matt Hoffman. I remember when I was at American Express Financial Advisors, we used to have these market link CDs. I don't know if you remember those, Josh, but basically they were 0 to 6%, and it was linked to the S&P 500, and they had a start date. It was usually end of the month. Goes 1 full month, and then you get whatever that return of the S&P was between 0 to 6%. If it was above 6%, you got 6. If it was below 0, you got 0.
Yep.
They were FDIC insured, and it was a good quasi product that would get people to move from cash into something that was market related returns. So
I remember those, man. I used to like those actually because they're pretty simple and people knew what they're saying. This is a max. This is the lowest. You actually knew. You had a band, and then we got a 1% commission. I don't know if you got 1% commission. That's what we got, 1% commission.
Yeah, I don't think we got that, but whatever. That product was there and it was growing, and it was a big piece of the business overall, if you will. But this industry of buffered products, and I want to say defined outcome products, is now $46 billion, and it's just like a rocket ship. It's like what do these Bitcoin people say, to the moon?
Yeah,
like it's gone straight up. Like the hockey stick has gone straight up. And so these buffered products, there are a lot of different types, and I want to review a couple of them. Yeah. So today what we're going to do is review a couple of them. Then we're going to talk about like who should actually buy these products and kind of what we do in terms of these products. But to start, I got a video to share, and I'm going to see if I can do this accurately. This one is from Innovative Shares. It is, I think, Innovative, First Trust, are the originals, like the OGs to this platform. So
okay, First Trust, interesting. Okay, I want to.
so I'm gonna share this like this. Maybe even if I can go full screen.
There you go. Yep.
All right, I'm gonna hit play. This is only 1 minute and 20 seconds, so bear with us.
Wouldn't it be great if you could buy an ETF that tracks the performance of a market to a cap and seeks to offer a downside buffer? Now you can. Innovator Defined Outcome ETFs are the first family of ETFs designed to keep you invested in the market with either a 9%, 15%, or 30% buffer against losses. Many managers attempt to manage downside risk over time. Innovator Defined Outcome ETFs, however, allow investors to choose their desired buffer level before investing. As the market declines, the ETFs are designed to provide a buffer of 9%, 15%, or 30% before fees and expenses, respectively. As the market rises, the ETFs are designed to keep pace with one-to-one upside participation. And if the market rises above the annual cap level, the ETFs will achieve their maximum annual return. These ETFs can be held indefinitely, providing structured returns on a point-to-point basis, resetting annually. No one knows exactly what the future may hold. Now, for the first time, you can invest in an ETF with a defined buffer against losses. Visit innovatoretfs.com/define to learn more. The funds have characteristics unlike many other.
All right.
You said that's First Trust? They did that?
Well, this one was from Innovator ETFs. Right. So this is a good kind of, and I think maybe what we'll do is just share the slide again and talk about some of the key aspects, because it is important to kind of see this. So the first thing here, they offer 3 different buffers, right? So the 9% buffer means from the S&P, let's just use S&P as an index here, from 0 to 9%, you don't lose any money. But at 10%, you lose 1% of your funds, and so forth. This one is a 15% buffer. This is 30% buffer. So the 30% buffer is really getting rid of all market-related risk. Although in a black swan event, and the market has lost 50% at times, right? So 35 to 50 is like the large drawdowns that you want to avoid. This is, capturing most of that. And then on the flip side, hold on
a second, Mar. So real quick, so if the market went down 57%, a la 2007 and 9, you would have only been down 27% because the first 30% would have been forgiven, essentially. If that makes sense.
20% plus the fees, right? Like all these products, the ETFs have embedded costs. They're usually under 1%, but there are, so 20%, 21%, yeah. So, and this is a kind of a good example here where they illustrate it with the downside.
Right there. That's good.
Right there. So, you're capped, and so if the market is down 45, here you're down, 15.
15, yeah.
And then, here you're down a little bit more and so forth. So just it's removing the first 9, 15, 30, right? To get that, you have a trade-off on the upside, which I think this is kind of shows it. It's that there's a cap on these, right? And the cap, limits your upside potential. And that's the big piece here. It's like, we want to kind of discuss this upside potential and what is the true cost of that upside potential, right? So, so this one was, make sure I'm sharing now my full screen.
So like, for instance, Kirk says his Roth grew at 14% last year. So you probably in that buffer, Kirk, you probably would not have gained that full 14. I mean, I don't know what the upside is, but let's just say that 15% buffer, maybe a 10% market cap or something like that. So you would have got the 10, but you would not have got the 14.
Yeah, exactly. So I wanted to show you this because they have this tool on their website which shows you different periods of time of this ETF.
Yeah.
So remember, this ETF is a direct period of time, right? It's point to point, and then it reestablishes a new NAV, and then it goes for another year. So it's point to point, yearly. The NAV changes, and then that's how you get your price appreciation or your buffered loss. So basically, from January to December, or let's just say February to November, it could do whatever it wants. That's not what your outcome is. You have to wait till that ending period. And when the NAV adjusts, that's what you get. But I want to share just like three things or two things that I think are key here. One, so here's the Innovator ETF. Here's where the market is. It was above the cap. You got basically up to the cap. But look at the cap here in this first illustration. This ends in 2024, so it just ended. The cap was 19%.
Okay.
If we look at 2023, that cap was 25%, right? So one of the risks that you run into these buffered ETFs is the cap is set on the renewal date because they have to look at the option chain and see what's available. And so that option chain pricing can change from year to year. And so each year you'll have the same buffer on the downside, but the cap will be different, right?
Oh, so you don't know what the cap is going in.
You don't know until the NAV date. So the I think it's like the 10 days before it gets issued, you know what the cap is. And so you can make a decision at that point, but there's a window there that you have to look at. Look at this. This is 2022. The cap was 13%, right? So if you think about it, you went from 13 to 25 to 19, right? So this option pricing is all over the place in this ETF, right? So it's not a constant cap.
So it went from 13 to 25 to 22, you said. Is that what you said, Amar?
That's correct. From January 1st, 2022 to the year end, that cap was 13.
Okay.
And then the subsequent years was,
And that was in the S&P 500?
So now this tells you what the S&P 500 does, right? So the S&P 500 this year, if we look at it, was down 19.5%. Your return was 11.21 on this ETF cycle or interval, if you want to call it. The next one.
Wait, hold on a second. You said the S&P was down 19, but the ETF was actually up 11%?
No, down 11.
Okay, gotcha.
Yeah.
All right, gotcha.
Right. This again, the 9% buffer, right? Like I'm just looking at the 9% buffer here. On the upswing here, the S&P was up 24.28%, and you got 23.48. And then on this last one where the S&P outperformed the cap, the S&P did 22.77. The cap was 19. You got 18.45.
That's that sounds reasonable to me, man.
Yeah. You know, the one that I actually like better than these buffers, because these buffers change, right? And so the real value is to protect on the downside, right? On the downside risk, right? So instead of buffer ETFs, BlackRock has created so everybody's getting into this game, right? BlackRock, I showed you the email earlier, First Trust, and there are a couple others, but Allianz, we just went to a seminar and Allianz was presenting there. So BlackRock has created one that buffers 100% of the downside. Let me make this bigger again so that way people can read it here. 100% of the downside gives you participation in the market, and so this is how it looks. You 0 to 10.6 is this interval, right? So you get zero risk on the downside and 100% participation up to 10.6. What does this look like to you, Josh? Does it remind you of something in the annuity business?
Exactly. It looks like an index annuities, man.
Yeah, exactly. It's an equity index annuity, except there's no participation rate. Right?
So you get all up to 10.
Yeah, 100% of the participation up to the cap. So,
and there's no surrender charges either, I wouldn't think.
There's no surrender. You could sell it halfway through. It's an ETF. It has daily liquidity, right?
It's got a ticker.
It's got a ticker. You can look it up. This ticker is MAX. Oh, let me go back to right here. MAXJ.
MAXJ. That's cool, man. I like that. That's a big. That puts a lot of. Let's put it this way. There's another new game in town other than index annuities. You know what I'm saying? That's
and look, this game is growing. It's $46 billion. You know, it went from not known 5 years ago to now 46 billion. This is a good way to kind of understanding the strategy as well, is that let's say we get that 35 or 2007, 2008, you got zero return, but you didn't experience this 35, 40% downward swing.
Yeah, absolutely.
Remember, when you have a 40% downward swing, 50% downward swing, you have to get 100% return to make that back up, right? Even if the market's down a little bit, you didn't experience that. On the upside, you get up to the cap, and if it exceeds the cap, you get the cap.
That's interesting. Yeah.
So, you know, BlackRock is another one that I think.
Hey, wait, scroll down. Was that payoff scenarios? What's that? Oh, okay.
Yeah, I mean, so here's a better way of looking at it.
Okay.
So what we're trying to show here, and we're not representing BlackRock, we're not representing CalMos, innovation funds. This is strictly for educational purposes, but I want to use this to illustrate in a real-time data of what the potential is here. Because this is an ETF, it has daily liquidity. So do you have to buy this June 1st? No. We could go today and buy it. But the market has gone up since June 30th. That's when this was issued. So essentially it's July, right? The launch date was June 28th. So we're a couple days into it. Those options have expiration dates that are, getting smaller. Market's gone up. So we're not going to get the full 10.64% cap, right? Since the market's gone up, the remaining cap is 9.49%.
Oh, it actually tells you what the remaining
tells you. I mean, BlackRock is putting it right here. Is if you buy it today, you're capping 9.5% of the upside, and you're exposing yourself to about 1.5% losses potentially.
Gotcha.
At the end of the cycle, right? So these are cycles. These are 1 year cycles. So I guess this would be June 2025, right here, June 30th, 2025. That you could have
crazy, man.
Either a 1.5% loss or S&P return up to 9.5%. Right.
Now you got to point out we're not getting dividends reinvested here.
That you just took the words out of my mouth there, Josh. It is that.
That's why they call me Steely McGee. I always stealing people's thunder.
Yeah. So there's some risk, right? Is that you're not getting cash flow, you're not getting dividends. This is S&P point to point, right? Yeah. Annuities work the same way though, right? So it's I think it's, if you're comparing to annuity, it's roughly the same downsides on that side.
And I got to interject. Hold on a second, Mark. You guys got to say too. A lot of people say, yeah, but the dividends accounted for 40% of the market return. The dividends don't pay anywhere near that anymore. They're just not. They're not paying 4% dividend yield. They're just simply not. So the dividends, because all the stock buybacks. So the stock buybacks have taken a lot of the luster out of the dividend strategies in the past. So Mark, people go back to 1926. Well, the dividends, if I don't get the dividends, I'm leaving 40% on the table. You just aren't, man, because they aren't paying the dividend yields like they used to. The payout ratios, all that are significantly lower. So again, I'm not here to push this product. I don't care, but. Yeah. Don't get caught up in this idea that the dividends, there you go, right on.
So Kevin points out a really good thing. And this is where I think the evolution of these products need to get to. There needs to be an ETF that tracks buffered ETFs. So when you're at the downside and when you're at the bottom of that particular ETF, the buffered ETF, you essentially have 20% upside.
Yeah.
Right? Because you have from one end to zero and then zero to the upside. So yeah, I mean, I think this could be.
But that's the BlackRock one. No, but the BlackRock one said because you bought after the market went up, you're already taking it. There's some risk in there. That black one, you know what I'm saying?
Yeah. Okay. So for the BlackRock one, you would have 10%.
Right.
Right. So
But I see what he's saying. I'm just saying I think it depends, because the BlackRock one said there is a little bit more risk because you bought it mid-cycle, if that makes sense.
So we'll have to double check that.
Remember you said it's sort of 1.55. Yeah, go ahead.
Yeah, what here is so if you're buying this reference asset below this, you're not getting from that below to this amount, right? Because the options have already bought.
Oh.
So you're getting from this amount to 608.
Actually, Kevin just said, but you bought it when the market was up. Oh, okay. Right, okay, understood. So, that's interesting.
Yeah.
So because we've already bought it when the market went up, I'm going back to the BlackRock example, Amar. Yeah. It had already given us some of that 10% positive. And so the BlackRock saying, if you're buying now, you still have a little bit of a downside. But Kevin's saying, but what if you bought it when it's down?
All the way down, right? And so then you've already hit the floor.
Yeah,
and what I'm saying is these options, we'll double check, okay? But my gut intuition is these options are bought at the start.
I think you're right.
So your net floor is still 0. You're not capturing more of the upside. You're just going from 0 to 10. But you have a higher probability of going up, right? And then that's where.
But remember, the BlackRock one had a ticker, whereas these other ones probably don't, Amar. They're probably.
They do. These are all ETFs. These are all publicly traded tickers.
Really?
Yeah.
So they're all daily liquidity.
All have daily liquidity. So to do what Kevin is talking about, where you're getting the upside swing,
interesting.
I think that's done better in a buffer ETF, not a 0% downside, right? So real quick, I mean, so when we're looking at this, you're experiencing, when we looked at the data, we went back 5 years, you're experiencing 41% of the volatility, and you're getting roughly 40-ish% of the S&P index return. So for those individuals that are in retirement or that are getting near retirement, I mean, this is a great product to kind of get your feet in the water, I would say. But remember, the downside is there's no cash flow, right? That's one of the biggest risks, is like you're not getting the dividends, you're not getting the cash flow. And in a nutshell, these are structured products in an ETF wrapper, but like, how would you use them? Because the protection you're getting on the downside is some level of protection, but you're capping the upside. And we know overall that the market is positively skewed.
Right, exactly.
Meaning that you're giving up on the large upside piece way too much in some of these products, but you're getting that protection. So you got to kind of analyze that. So why buy these? I mean, I think there's a large percentage of the population that doesn't trust the public markets. They don't trust the stock market, right? And they would rather have a defined outcome, right? And so this is a good way to kind of get your feet in the water. I think there are some people that have a loss aversion risk,
yes,
right? Like they don't want to have losses. They don't want to have, when you have $100,000 loss, that there's more pain there than when you have $100,000 gain. There's less, joy from it, right? So we hate the loss aversion piece, right?
When these matured, Amar, do they just liquidate like a CD? Just says, here's your money back?
No, they just roll into the next one. And so that was my point, is that with the Innovator, you could see year over year, and the NAV just changes with the new ETF, right? The new options chain in that ETF.
Yeah.
So, I mean, the loss capacity, that's another thing, right? A lot of individuals, when we look at loss capacity, they may not have the loss capacity, and they don't want the downside. And so
they can't afford it.
Yeah, and some people, if you have 200,000 and you lost 100,000, that ruins your life. If you have, $5 million or $2 million and you lose 100,000, that's just normal volatility of the markets, right? The other thing is that I think there's a specific group of people that have very narrow framing, and what I mean by this is when they look at a diversified portfolio and they have, like, let's just make it easy, 5 investments, and all of them are doing well except for one, all they can focus on is the one that's not doing well.
Exactly what I'm saying.
And saying, why don't I have the ones that are doing well, right? And that narrow framing it's behavioral finance, and those people can't evaluate risk separately, or they only evaluate risk as an individual sleeves instead of holistically. And I think this type of product would probably do well because the market is positively skewed, right? And we know that. And there are extreme upside events that bring up the overall average of the markets, right? We want to have exposure to that. So I just kind of like a side topic want to talk about how do we implement this in our practice, right? And what we do is that we have a variable portfolio and a low risk / risk-free portfolio. And we can titrate the amounts in each one of those based off of the level of risk or the loss aversion a client can have. And that way we can create some market exposure, right? And then some buffered or downside risk protection by having low risk investments. So, think about this. Another way over a longer time period to get the same type of overall return as this is if you had 40% in like BTI or S&P 500 or some index, and 60% in like a bond fund that is less than 3 months in duration, right? The combination of that will give you almost the same outcome, right, as one of these. So,
well, until 2022 came around, remember 2022, man, the bonds and stocks both went down significantly. So that this buffer stuff would have avoided that. No, it's not very likely to happen again, but it did happen in 2022, just 2 years ago. So,
yeah, and so that's what I was saying, 3 months or less, right? So CD, like T-bills, right? Yeah, T-bills. So you have principal like kind of protection, and it's rolling on a more frequent.
Yeah, but remember back then, no one wanted T-bills, so they're only paying 25 basis points. So this is where it's like, see, right now T-bills are great. So people are like, why wasn't I in T-bills? Because they weren't paying crap back then, and no one wanted them.
Yeah.
It's like.
All right, so let's go through some questions so that way we can be respectful for everybody's time and make sure we end on 30 minutes. So
no one's on a Scandlen stream, says Kevin. Oh man, okay. Yeah, interesting. So I don't have anyone. That's all right.
Thank you for this comment. Woohoo!
The great financial duel, yes, sir. Amar and I are gonna meet at the flagpole. You guys got any questions, comments, thoughts about this? Because it's pretty interesting to me. Oops, I just had it.
Yeah.
Let's go back. I'm just trying to check my. I moved to high yield savings a year ago, and now those suck. Why they? I don't get it. Why they suck? I don't get it, Kurt. How come I can't click on this? Weird. How many people are you showing on your thing up there, Mar, that says how many people are on here?
25.
I think when we changed the link, I think we kind of screwed that up a little bit.
But yeah, maybe.
We'll figure it. Next time will be good.
So,
is this an alternative to CD? Says, here we go. Go ahead, Amar. Go ahead.
No,
Marie.
So yeah, I mean, if you're young and you have a long time horizon, there's nothing like just being in the markets, right? Kevin, my guess is that you get nothing until the market recovers. Yeah, I think this is right. You get a return kind of the 0 to, you only get the upside portion because the options were bought in June, right? So they're not going to give you what the options are worth at that point because they'll be worthless and then they come back. So I agree with that. There you go.
Yeah. Defense wins championships. Offense, hey.
Yeah.
I'm here, but Amar is over my pay grade, says Penelope. But not me, Penelope. I'm not over your pay grade. Okay. Here's Carl. Actually, let's go. Hold on a sec, Carl. We're gonna skip because we got some other ones. Marie says, "Do you think this is a?" There you go. Right on, Amar.
Alternative CD. I mean, like when we started this, when I was at American Express, we sold these market link CD products, and it's very similar to this. I would say the BlackRock one is probably closer related to the CD because there's zero potential for. I mean, there's a internal expense, so maybe like let's say a 1% potential loss. But these are not FDIC insured, right? They're market linked securities. They're actually, what's it called? SIPC insured.
SIPC.
SIPC, yeah.
But remember, SIPC is only for fraud and stuff. I mean, it's not.
Yeah.
So.
And these are on large indices, right? So if you think the S&P 500 would go down completely, I guess there would be bigger problems in the actual product. What is the expense ratios? Well, here, I got the BlackRock one still on my screen, so I can share that. Right here, net expense ratio, 0.5%.
I mean, that's pretty, Drewski, that's pretty fantastic given how these things used to be charged back in the old. It used to be like 2.25%, 2.5% back in the old days. Crazy.
Yeah, so the innovator one, or the other one that I was just showing earlier with the buffer, that was about 0.75.
I mean, that's really Amar.
So less than 1%.
Less than 1% for a cent, and I can't say 100% because it depends on the product, but significant downside risk. That is, and they're just buying options on this. I mean, that is pretty fantastic. It's amazing. It's amazing. So I'm not saying buy it. I'm just saying it's amazing.
So this is a good question.
It's Carl. It's not a good question.
So I mean, this is a conversation that you need to have with your overall financial plan, right? So what is your actual plan? How much risk you need to take on there to meet your goals? And then the second component of that is how much loss aversion can you face, right? And how much do you want to protect of that? So that is definitely a conversation that, that needs to be had beyond just the product. So then once you have that conversation, build it into the plan, then you can back into, hey, this is how much I want in structured products or protection, right? And if you want to have that conversation, happy to have it with you. You can find our information. Client First Capital Learning is our YouTube channel. And then our website is clientfirstcap.com. We have a newsletter, one issue a month. So just 11 a year. Please subscribe.
Don't see the liquidity. If the market is up over the cap, what kind of return would you expect?
I think so there'll be a differential there, right? Because option prices are paid up front, right? So like I would think of the delta of the fees to decrease as you get closer to the expiration of those options, meaning that let's say if the index is up 5%, you may be up 3%, even if your cap is 10, right? So there'll be like a 2% fee liquidated up front. But then on the back end, that 5 and 3 get closer together, right?
I guess that's all the questions.
I don't get what this question is if you bought it at that time or that comment. Cool. We're at 30 minutes. Josh, should we end the stream here?
Yes, sir. Good stuff, Amar. So let's see, 2 weeks. Are we doing 2 weeks? Yeah, 2 weeks from now, right?
I think so. Look, the summer's been hard for Josh and I. I got young kids in summer camp and trying to, play Uber driver for sports and stuff like that.
Dude, you don't even want to hear him.
I will do a better job in September.
My kid was up in about an hour and a half north of us at a camp with a couple of his buddies. He left his glasses at home. So I had to drive all the way up there to deliver his glasses last night and come all the way back. I punched him in the face. I said, man, talk about an Uber driver, man.
Yeah. But in September, I think Josh and I will get back on a regular schedule. Just
absolutely.
Now we know how to post these live streams in advance.
Yes.
We've been working, we're not the smartest tools in the shed with technology. So now that we got this component done, I think we'll be more regular in posting maybe on Monday. So on Wednesday, you guys know that we're having a live stream.
And then invite your friends to see this stuff too, guys. Say, hey, these crazy cats, Amar and Scandlen, are going to do a live stream. Jump on board. Just last question, Amar. Kirk says, what age should you start taking risk off the table, essentially? Kirk, that's no right answer for that. It's so many things to talk about on that, unfortunately. There's just really no right answer. I'll just say, for me personally, having and I have a mortgage. Once that mortgage is paid off, I can be a lot more aggressive. Let's put it that way. All right. God bless. See you guys. Thanks.
Yeah.
Thanks, Mark.
If you need help, reach out.
And how about your newsletter? Oh, you already talked about that.
I already did. Yeah.
All right, cool. All right, on. See you guys.
Put a thumbs up. Bye.
Thumbs up. See you, man.
Bye.
All right, goodbye. Cool.